Understanding Fed interest rates and the stock market. The Federal Reserve sets interest rates, which can significantly impact the performance of the stock market. Rising rates tend to slow economic growth, while falling rates often stimulate the market. What are Federal Reserve interest rates? The Federal Reserve, the central banking system of the United States, adjusts short-term interest rates to influence economic conditions. These rates impact borrowing and lending across the economy. How do interest rates affect the stock market? Rising rates. Higher rates make borrowing more expensive, reducing corporate profits and investment. Falling rates. Lower rates encourage consumer spending and business investment, boosting stock prices. Investor outlook. Investors closely monitor rate changes to anticipate market impacts. The impact of rising interest rates on stocks. Slowing growth. Higher rates slow economic growth, reducing corporate profits. Increased borrowing costs. More expensive loans decrease business investment and consumer spending. Investor caution. Investors may become more risk-averse, leading to stock sell-offs. The impact of falling interest rates on stocks. Boosting demand. Lower rates spur consumer spending and business investment. Reducing borrowing costs. Cheaper loans help companies grow and expand. Investor optimism. Investors are more willing to take on risk. Market rallies. Falling rates often lead to rising stock prices. Factors influencing the Fed's interest rate decisions. Inflation. The Fed raises rates to slow rising prices. Employment. The Fed cuts rates to stimulate job growth. Economic growth. The Fed adjusts rates to maintain sustainable growth. Global conditions. The Fed considers international economic and political factors. Investor strategies for navigating interest rate changes. Diversify. Spread investments across sectors to minimize risk. Adjust allocations. Shift towards defensive sectors during rate hikes. Stay informed. Closely follow economic indicators and Fed policy. Take long-term view. Volatility is temporary, focus on fundamentals. Staying informed and adapting to interest rate fluctuations. Understand the relationship between Fed rates and stock market performance. Monitor rate changes. Closely follow the Fed's policy decisions. Adjust investment strategies. Adapt to market conditions and rate fluctuations.